My entire career pivoted on one realization: trading success is not about prediction, it is about execution. The losing trader starts the day asking, "Where is the price going?" The professional trader starts the day asking, "Where is my statistical edge today?" I had to brutally dismantle the narrative I had built around myself. Every failure, every drawdown, wasn't the market punishing me, it was the inevitable consequence of my own internal inconsistency. My stop loss was arbitrary. My sizing was based on my confidence level, not a mathematical formula. I was engaging in revenge trading, using an escalating amount of capital to prove a point to the market, a point the market simply does not care about. The first rule of my transformation was to introduce a layer of brutal objectivity between my emotions and my execution. I had to learn to sit in the silence of the screens and view the market not as a battlefield, but as a vast, probabilistic data stream. The professional's first defense, the 1 to 5% rule. The immediate and most difficult psychological barrier I had to break was my relationship with risk. The losing trader sees risk as a necessary evil that must be minimized or overcome. The professional sees risk as a fixed, unavoidable cost of doing business. I built my defensive system around a single, unbreakable rule: never expose more than 0.25% of my total capital on any single trade. This low exposure initiation is the foundational defense of my mental capital. Why 0.25 fence? Because a loss at this level is a data point, not a crisis. It removes the sting of failure. It allows me to stay emotionally flat when the market hits my stop. I can calmly analyze the failure without the panic that triggers a spree of disastrous follow-up trades. If your risk exposure causes your heart rate to spike, that trade is already compromised. You are no longer trading the chart. You are trading your anxiety. The paradox of dynamic risk, scaling with house money. Once I secured my mental fortress with minimal initial risk, I introduced the mechanism for growth: dynamic risk management. The losing trader tries to scale up risk based on external confidence, often leading to oversizing a marginal setup. The professional only scales up risk based on internal capital growth. My rule is absolute. I only increase my position size by leveraging the profits I have already made that day, what I call house money. This creates a powerful psychological firewall. I am using the market's money, not my core savings. If I lose that capital, I am back to zero for the day, but my initial capital remains untouchable. This allows me to trade aggressively when the market is paying me, and forces me to be disciplined when I am starting fresh. It turns every profitable sequence into a compounding opportunity, and every drawdown into a contained minor event. The successful trader understands that the true art of compounding is not in maximizing the win, but in maximizing the consistency with which you apply a low-risk strategy. The first chapter of my success was written by defending my mind and my capital, not by chasing profit. The illusion of price action. For years, I was a dedicated price action trader. I studied support, resistance, and candlestick patterns. And while these tools give you the market story, the result of the battle, they don't tell you the intent of the players. The losing trader sees a large green candle and thinks, "The buyers are winning, I must chase the price." They are reacting to lagging data. They are trading the effect, not the cause. My technical breakthrough, the moment I truly separated myself from the pack, was when I introduced order flow analysis. This was the moment I put my existing price action strategies on steroids. Order flow is not an indicator, it is a live feed into the market's DNA. It allows me to see the aggressive intent of institutional orders, the real money, and, crucially, where liquidity is being trapped and absorbed. The power of trapped liquidity. I look for two primary confirmations that reveal the market's true intentions. First, I use the cumulative volume delta, CVD, as my lie detector. CVD tracks the net aggression, the difference between market buy volume and market sell volume. If the price is rising, but the CVD is flat or declining, it means the large aggressive buying pressure is dying out. The upward move is being pushed by weak hands. This divergence is a clear warning. The market is lying to you. It is a critical signal to avoid a long trade or to begin building a contrarian short position. Second, I utilize the footprint chart to identify liquidity absorption. When aggressive selling hits a specific price level, but the price fails to break lower because passive limit orders from major institutions are absorbing all the pressure, that is, absorption. This reveals the precise location of smart money defense. This mechanism allows me to execute the sniper's entry. I can place my stop loss extremely tight, right behind that institutional wall of defense. This single technical insight, locating trapped liquidity, is what allows me to achieve the highly asymmetrical risk-to-reward ratio that fuels my compounding success. I gain the necessary statistical edge not by predicting where the price goes, but by knowing exactly where the price should not go. The champion's focus, mastering one asset. Another fundamental difference between the professional and the lost trader is focus. The losing trader trades a chaotic watch list of 20 uncorrelated assets, jumping from oil to EUR USD to gold, always searching for the next big volatility spike. This leads to shallow analysis and dilutes their statistical edge 19,000 on 19,000 video 2. The professional masters ON domain. My domain is the NASDAQ futures NQ. I know the NASDAQ's personality, its statistical deviation, its hourly volatility, how it reacts to specific economic news releases, and the precise liquidity zones of the opening and closing hours. This intimate knowledge, knowing the engine of one specific asset inside and out, gives me an analytical advantage that the generalist can never replicate. If you don't know the personality of your asset, you are trading in the dark. My success is built on a simple premise. I trade my edge, and my edge is built on the deep mastery of the NASDAQ's mechanics. The paradoxical fear of the empty table. When a trade moves into significant profit, a deeply rooted human emotion takes over, the fear of giving that gain back. I call this the fear of the empty table. You see a large, unrealized profit number flashing on your screen, and your survival instincts scream at you to lock it in before the market turns. This fear causes the typical trader to commit one of the cardinal sins, cutting winners short. They take profit prematurely, accepting a 1-1 or 1-1-1-5 risk-to-reward ratio, even when the market structure clearly suggests a move to 1-5 or 1-1-1 is possible. By doing this, they destroy the positive mathematical expectancy of their entire trading model. The small wins cannot possibly compensate for the necessary small losses. My solution to this intense psychological stress is mechanical, not emotional. The mechanical defense against anxiety. My strategy for managing profitable trades is purely deterministic. I remove the stress by removing the risk. The moment my trade achieves a key structural milestone, for example, a sustained break above a high-volume node confirmed by aggressive buying on the CBD, I immediately move my stop loss to the break, even point, or into a guaranteed profit zone. This mechanical action has a profound psychological effect. The trade is now risk-free. I have completely decoupled the trade's outcome from my personal capital. This allows me to step back, detach from the outcome, and let the market's true structure and momentum determine the final exit, rather than my internal anxiety. The trade is now a passenger. I am the pilot focusing on the larger journey. The contrarian mindset, exploiting the herd's errors. This detachment is also crucial for the third pillar of my success, contrarian thinking. The losing trader looks at the media and the market chatter to confirm their bias. They follow the herd. The professional trader knows that profit is earned from the errors of the majority. My analysis is always filtered through the lens of retail sentiment. I understand that the average trader is usually wrong at key turning points. When the sentiment reports show an overwhelming consensus, for instance, 90% of retail traders are long, I become immediately skeptical. This consensus often indicates fuel for the opposite move. Seeking the weakness, my order flow confirms this contrarian view. I look for long entries when the retail crowd is heavily bearish, and I look for short entries when the crowd is euphoric. I search for the institutional footprint that is absorbing the emotional trades of the herd. Asymmetrical entry, I am patient. I don't chase the trend with the crowd. I wait for the market to retrace to my specific key support or resistance levels. knowing that this level is where the institutions are actively defending their positions. This patience grants me an asymmetrical entry point, a tight stop and massive potential upside by taking advantage of the panic or greed that forces the crowd into less optimal price levels. This commitment to objectivity, even when it feels uncomfortable to trade against the crowd, is what truly separates the consistent winner from the occasional lucky trader. The true cost of trading: time. The highest form of success in this business is not measured by the size of your portfolio, but by the amount of time you buy back. The losing trader views trading as the fastest way to get money, unaware that they are trading their emotional and physical health for short-term gains. They are trapped by the screen. The professional trader, upon achieving consistent profitability, must recalibrate their goals. High-frequency scalping, while highly profitable, is a relentless, high-stress endeavor. It demands constant, focused screen time. This is not a lifelong model. This realization led to my final major strategic shift. I started to prioritize time over performance. The evolution, diversification for longevity. To ensure longevity, the professional must evolve. I began diversifying my approach, leveraging my capital into strategies that require less frantic screen time, swing trading and options, swing trading and macro analysis. By stepping back from the minute-by-minute chaos of the order book, I began incorporating macro fundamentals. I started studying the Commitment of Traders (COT) report, which shows the positioning of institutional funds and commercial hedgers, revealing the long-term intent of smart money. I combined this with seasonality analysis and structural charting to identify large, multi-week moves that offer asymmetrical returns without the psychological drain of scalping. The statistical power of options. My transition into options trading is driven by pure objectivity. Options allow me to treat trading as a deeply mathematical and statistical business, utilizing strategies like hedging and spreads that aim for constant, predictable returns over months, rather than relying solely on the market's directional volatility. This is trading as an engineer, minimizing directional risk and maximizing the probability of a small continuous edge. The professional understands that scalping is the boot camp. It teaches you discipline and precision. But swing trading and options are the career. They offer control, lower stress, and the freedom of time. The ethics of a professional. Finally, we must address the ethics of this profession, particularly the integrity of the information we consume and share. The trading industry is, unfortunately, flooded with noise, with self-proclaimed gurus selling holy grail strategies without ever showing an audited track record. They preach complex concepts remodeled from genuine educators, often without understanding the underlying mechanics. The losing trader chases these empty promises, seeking a shortcut that doesn't exist. The professional operates with complete transparency and skepticism. My advice is direct, demand proof. Always ask for audited, sustained track records. If someone sells a strategy, their performance should speak for itself over multiple years and different market cycles. 3 phases of validation. Before risking a single euro of your hard-earned capital, put your strategy through 3 non-negotiable phases. 1. Backtest the data for 1 to 2 years to confirm your statistical edge. 2. Virtual live trading. Demo to confirm the robustness of the execution in real time. 3. Live trading with minimal risk. Trading is a tough but honest profession when approached with integrity. The challenge lies not in the complexity of the market, but in the simplicity of adherence to proven, repeatable rules. The legacy: my journey from a struggling trader fueled by hope to a disciplined scalping champion was not about finding the perfect entry. It was about creating the perfect daily routine, defending my capital with an unbreakable risk code, and building a system that allows data, not emotion, to drive every single decision. If you take one lesson from my experience, let it be this: your primary job is not to make money. Your primary job is to survive. Build your defense first. Master your single asset. Embrace the silence of the screens. And then, and only then, will profit become the natural, mathematical consequence of your relentless discipline. Thank you for listening. Keep your risk tight and always trade with your mind, not your fear.